The US jobs report on Friday promises to be a huge event for financial markets. The reason being that we've seen incredible resilience in the US economy in recent months and incredible stubbornness in the inflation data, not just in the US, but around the world as well. And that makes the jobs report all the more important because if we're not going to see more slack in the labor market, then it makes it very difficult for the Federal Reserve to pause the tightening cycle at a time when inflation and core inflation is still running well above target. At this point in time, policymakers were hoping that we were going to see more progress. And while we have seen some small signs, we haven't yet seen enough that would warrant that pause in the tightening cycle. The jobs report itself on Friday is expected to show some cooling, but I'm not sure it would warrant enough in itself to get enough Fed policymakers on board. At this point in time, the consensus view is that we'll see jobs growth fall just below 200,000 in the month of May. And at the same time, we will see a slight moderation in wage growth to 0.3% and also a slight improvement on the unemployment as well. But these forecasts have been known to be too optimistic at times, and we've seen many disappointments over the course of the last 18 months or so. So there's going to be a lot of attention on this jobs report on Friday to see whether sufficient progress is being made or not. At this point in time, markets are constantly changing their mind on what we can expect from the next meeting. I think really what we can take from how markets have positioned over the course of the last couple of weeks is that it's viewed as a bit of a coin toss between pausing and hiking. There is also another inflation report to come over the course of the next couple of weeks, the day before the Fed meeting, and that will be crucial as well. But at this point in time, markets believe there's more chance of a pause than a hike. But we really are just fluctuating here between 60-40 either way in terms of pausing or hiking. So there is clearly a lot of indecision in terms of what we will see. Some policymakers have been speaking in recent weeks suggesting that it's the wrong time to pause, that we haven't seen enough progress on inflation, but also on the labor market and the economy as well. And then we've also had some policymakers recently who seem to suggest that we can pause at this meeting and then resume at the next meeting if we don't see the data that doesn't warrant ending the tightening cycle. So there is clearly a big split on the committee, and it's that vote that's going to be so interesting at this meeting. Also, this meeting does include new economic forecasts, so that'll be interesting as well in terms of determining how much further the Fed believes it has to go. And in terms of what that means for the dollar, well, we've got a euro-dollar chart here, and as you can see, we have seen some strengthening of the US dollar more recently and over the course of the last few weeks, and there's probably been a few different reasons for that, one of which has been that the data more broadly has disappointed and it's triggered a bit of a corrective move, both in terms of the markets, but also in expectations as well. And that has favored the dollar, which had a bit of a sort of weakening from the end of last year going into this May period. So we've seen a bit of a corrective move in the dollar, which has driven this pair from around the 110 levels back to around 106, 107, where we currently stand. And the question now is, how much further is this correction ultimately going to run? And is this a correction at all? Is this just a resumption of the dollar trade? And if you look at the momentum indicators at the bottom, you can see that it does already seem to be losing a little bit of that momentum. You can see that we've made lower lows in the euro dollar over the course of the last couple of weeks since breaking below that 55, 89-day simple moving average band. That's the two purple lines on the chart. But at the same time, the stochastic has made higher lows and the MACD histogram has also made higher lows as well, leading to a steadying off in the moving averages on the MACD as well. So it suggests that we are losing momentum. That doesn't necessarily mean we're going to see a trend reversal, but it does suggest that we are losing momentum as we move closer towards that 104, 105 level. And what makes that level so interesting is we've got the 200, 233-day simple moving average band. So that's the two red moving averages there. And it also coincides with the lows from March and January as well. So that makes this a really interesting zone of potential support as well on the downside. And the break below here could suggest that we are seeing a much more strengthening in the US dollar and also much more hawkish expectations for interest rates, both in terms of how high they'll go and then how long they will stay at those highs as well. But I think we need to see a lot more economic data to justify that over the coming weeks. And in the run up to that Fed meeting, there is plenty still to keep our eyes on. The two most notable ones, as I've already said, the jobs report on Friday and the inflation number the day before the Fed meets in the middle of next month.